welcome this large crowd to our seminar workshop on the 990 traps and tips. And also, we will be able to get to the next phase, which I wasn't sure, due to typically a lot of questions, and that is revocation, losing your tax exemption, and getting restatement. So we're definitely going to be able to get to it today. Plus, we'll have a lot of time for your questions. The way I usually do my lectures is very interactive. So I don't wait until you hold your questions until the end. You can, if you have a question while I'm talking, unless it's very expansive, the answer I have to give you, then I'll stop and answer your question rather than try to wait to the end and you'll forget what the question is. Just really a very quick, so you know my background and why I'm even teaching this course. My name's Laurence Scot. People call me Larry. I've been in business 37 years as an accountant. The last 25 plus, I'm a partner in my own firm called Scot & Company. Our firm is a boutique firm that is under 15 people with part-timers and specializes in not-for-profits. About 90% of our client base is not-for-profits and pretty much covers the gamut of every type of not-for-profit. In addition, I have been teaching for many, many years, and I created 2 certificate programs. One that used to be given at NYU, a 4-course certificate program, and one that's now being given at Baruch, if anybody's interested. We cover this material and a lot more. And you attend 10 classes and you get a certificate in not-for-profit accounting and financial management. And it's given on Wednesday nights here. That's a little plug for Baruch. I've also been on boards, chairperson, treasurer, and what I basically do is auditing and reviews and consulting. And as far as the 990 goes, our firm probably prepares over 350 990s, 990, 990 EZs. So we pretty much come across most situations when it comes to doing the 990. And like I said, my firm is probably one out of maybe a handful of small firms in New York that specialize in what we do. All the big firms, have a not-for-profit division, but very small firms don't, although not-for-profits are becoming really big as far as I'm going to talk in a minute, as far as the number of not-for-profits in the United States and growing. And now pretty much everybody is trying to get into the act of either servicing them or working for them. And you're going to see in a second how explosive it is. But again, a lot of small firms are preparing the 990, meaning CPA firms. They're starting to branch out. And unfortunately, they don't really have the experience of doing the 990. As you're going to see, a lot of things are very tricky on the 990. So many times our firm takes over 990 and we go through it and scrutinize it and see a lot of things that weren't done right. Just like anything else, it's experience. And the other thing is, I've been on boards. How many of you are on a board of directors or sat on a board? 1, 2, everybody, or almost everybody. Being on a board, you really get the other side, decisions made. The 990 is usually presented or should be presented to you for review. So you should be familiar with it, even if you're not actually approving it, but if you're on the board and you should be reviewing it. Okay, we're going to talk about the 990 and some general observations. Real general general comment. Every not-for-profit exempt organization that is a public charity must file a 990, 990 EZ, or 990N, unless they are exempt by law. Very few are exempt, religious organizations being one of them. Churches, mosques, synagogues. As I said, some statistics. More than 1 million 990 forms were filed last year and each year. and that number is growing exponentially. This is my comment. I don't know if some people would have a different view of different tax forms. The 990 is probably the most transparent return filed with the IRS. Transparent in the way of stating more facts underlying what the organization does. Now, public companies file with the SEC a lot of information, but if a small corporation, if you think of a mom and pop store or a small retail store, they do their corporate return, nobody sees it. Even a small not-for-profit has to disclose all kinds of information like salary. So they're extremely transparent. And the reason for that is the not-for-profit has a benefit. They don't pay taxes. And people get a benefit when it comes to public charities of getting a deduction on their tax return. So to protect everybody, they make the not-for-profits disclose a great amount of information on the return. For the most part, the 990 EZ is open to the general public, which means anybody could see it. That's been a rule for a long time, but in the past, what you had to do is contact the organization and ask for a copy. Now, with the internet, pretty much you go right on the IRS. The IRS has a website that'll tell you if they're exempt. You can actually go to GuideStar, which a lot of you know about, or New York State, you can go to the Charities Bureau and get information, usually a little behind the times, like 6 months to a year, but you can get the information eventually. 990s are used by pretty much everybody to understand what the organization does. It's used by the boards of the not-for-profit to run it, but it's used by the general public. Donors look at it, government regulators definitely look at it, foundations giving money look at it. So everybody has their nose in the 990, which makes reporting it properly so important.
Can I ask a question?
Sure.
When do you have to file your first 990? Our organization is just incorporated now, so when would our first 990?
First year.
First year, okay. So
Even if you're not exempt. I'm going to talk about that in a minute. As soon as you're incorporated, that year you file. And here, I don't think I have it on a slide, but even an organization that starts up and has no activity should file and put 0, because they're going to take that year as non-filing as one of the years, and you might have a problem down the line. So even if it's 0, even if it's $50, you should put it down.
First year after you incorporate?
Yes. Okay. For this seminar, what I did is actually, you're going to see this throughout all the slides, I actually put tips and traps to highlight certain things so you don't have to gleam it out, and also put some problems, errors that will typically happen in my experience looking at the 990s and 990s EZs, things that have come up, and so I thought I would kind of illuminate it with you. Errors on the 990, why they're not correct. I made 4 basic categories, kind of generic and general, but they capture a lot of area. First one, if I had to pick one, probably the biggest, is poor accounting records. Basically, you have to keep your books, a full set of books, and it should be done on a computer program. QuickBooks is one of the, probably one of the widest, if not the largest, software program being used. And in order to report information on the 990, you have to capture the information and have a set of books. You need to set the books up properly in order to capture the information, and that means setting up your QuickBooks properly. Many not-for-profits, in my experience, do not set up their QuickBooks properly and do not have the right accounts. So if they don't set up the QuickBooks properly, they're not going to have the information to report on the 990.
Do you have a suggestion for like a small nonprofit, getting like what is a good thing? So QuickBooks would be something that's good to get.
There are 2 or 3 small programs. If they're small, they don't want a big, expensive program like Financial Edge or something. But QuickBooks is, my experience, is probably the most popular. And now they're pushing QuickBooks Online, which is in the cloud, so that it's good because many times, more than one person needs to work on it. And the executive director is one place, the treasurer is another place, And and then the accountant who's doing, or the bookkeeper's in another place, and this way everybody can access it. You also have to be careful what you let people do. They can't be able to transfer money out, but QuickBooks Online is now becoming like the premier program to be used. Okay, so setting up QuickBooks right is a problem. And then the next thing with the accounting records is, kind of dovetails with setting up QuickBooks correctly, is tracking certain types of activities that not-for-profits don't even know they need to do. And the person preparing either the 990 or a financial report will either know or not know they need this information, such as by accounting rules, a not-for-profit must track their activities by program, by discrete activity program. And you must report those activities on the 990, total expenses. If they don't separate their expenditures or expenses by function, by program, and by management in general, and fundraising, they can't report it that way, and that's a big problem. They don't capture it, they have problems reporting. So when it comes to 990 time, or preparing the 990 easy, the information is not readily available and must have to be, the preparer has to actually try to get the records out from the original documentation or from digging into the general ledger. Okay, that's the first one, poor accounting rules. Next one, the staff bookkeeper accountant's lack of technical knowledge in what needs to be tracked, what needs to be reported. Many bookkeepers, there is a shortage of not-for-profit bookkeepers. There's a shortage of not-for-profit accountants. I teach a lot of courses all over. Many CPAs come to these courses. They do one or two not-for-profits, and they don't understand the accounting rules. And there are specific accounting reporting rules for not-for-profits. They don't understand it, so they can't report properly. They don't understand there is something called generally accepted accounting principles. Some of you might have heard of that, GAAP. There's specific GAAP for not-for-profits. And if somebody came from a commercial world, like a lot of CPAs that do tax returns, when they get to this part, they don't understand the terminology, and therefore they don't know how to report properly. Also, the lack of technical knowledge. Some people are not bookkeepers, but they're good with numbers. I can't tell you how many not-for-profits will pull anybody to do the books who says that they'll do it. I have a brother, he's an insurance broker, but he's good with numbers, he worked with QuickBooks, he'll do the books. And it goes on and on and on. And I could say most small not-for-profits have somebody doing the books initially, sometimes perpetually, without any real accounting knowledge, and definitely without not-for-profit knowledge. How do they learn? They learn going forward making mistakes. A lot of the mistakes show up in the 990. 3, lack of information about certain activities. It's not even putting it into the system wrong and tracking it, but it's just not known. I picked probably one of the biggest ones are related party transactions. The IRS and accounting rules say you must disclose related party, meaning that a board member has a relative that works somewhere that the organization is dealing with, and therefore it's a related party. You must disclose this. How do you know to disclose it if nobody knows about it? Meaning that the board member didn't tell anybody. It's not out there. A lot of this is non-financial information, but it has to be reported. So you don't have the information, you don't know about it, you can't report it. Compensation is another one.
If you say it's not, the related party transactions, if they're not financial, can you give an example of what that would be?
Related party. I have a wife who is the bookkeeper of the accounting firm that does our audit. There's possible conflict there. Possibly not, but probably yes. That's not really financial. I'm a board member, and my brother works for an insurance company, and that's our insurance company, related party. And the whole reason for reporting related party transactions is to make sure that something nefarious is not going on, some deal.
If you're doing it pro bono, you would still call that a related party transaction?
If they're doing it pro bono, you don't report dollars, but it is a related party anyway, because they might have, even if it's not they're getting paid, they might have undue influence. And there are actually rules in New York State under the Revitalization Act that says how you're supposed to pick a related party and how they should be approved by the board. That's another issue. But on the 990, they ask you to disclose all related. Here's another one. If two people on the board are related, or one person works and one person's on the board, you have to disclose that. It's just a disclosure. It doesn't mean something's wrong happening. It just has to be disclosed.
Does materiality count in this?
Say that again?
Materiality counts in the related?
Does materiality count? Materiality counts pretty much for everything. But again, with related party, it might not appear material, but might be material. So materiality, one of the things is usually defined by volume, by dollars. But sometimes materiality might be a causal effect, that even though, how do you define influence? So yes, it could be very important. If I'm on the board and my relative is in the organization, how independent can I be on the board, which I'm supposed to oversee the organization's activities? I've had that situation in some clients where the chairman of the board had a significant other, which was the top finance person. How do you oversee their activities and have control over it? There's kind of a lack of independence there. So it depends on situation by situation. Okay, moving on. In addition to the form not being prepared correctly, the schedules are not prepared correctly many times. So many times somebody preparing by hand, not electronically, because that might give you a notice that something's missing. But if you do it by hand, you might not even know you have to include a Schedule A, Schedule B. And as we'll talk about, that's a major reason for the 990s getting kicked back or a notice from the IRS. I'll come to your question in a second. Another problem is not filing extensions. Very big problem. And we're going to talk about it in a minute. If you don't file extensions, then you're late in your filings, and there are penalties associated with that. Yes, what was your question?
I have two questions, actually. I mean, talking about the board members and the conflict of interest, if a board member, has a relative who's in the organization. But in our organization, the board members actually are the officers and actually are the ones who run the organization.
Is it a religious organization? Yeah. Okay. The reason I ask is that's very common. I could talk to you more in detail, but there are certain organizations that have that happen, but for the most part, it's not a good idea. I have one organization that's not religious, but the management is 4 people, and they are the board. And depending on their size, and do they get compensated?
No, nobody gets compensated.
Okay. Okay. That's better as far as independence goes, but if you did, that would be a lack of independence. But if you understand what the board's responsibility is, which is to oversee as trustees of the organization, if you're management and the board, there is no separation. So for a small organization, that might be practical, but I would probably suggest even having one person on the board that's not management, and it's a volunteer. But I can talk to you later. Okay. The consequences of filing a 990 or 990EZ or 990N, which I haven't really spoken about yet, but I will, late. As you know, if you file your tax return late, individual or corporation or partnership, there's a penalty. I think the not-for-profits, the penalties are pretty steep. If you're an individual or corporation, your penalty is based on how much money you owe. The not-for-profit is not based on how much money you owe for taxes because there is no tax that's owed. So therefore, they came up with another method of assessing taxes, and it's pretty steep for filing late, even if you think it's not that late. Let's take a look at it. There's 2 tiers. Organizations with gross receipts that are under $1 million and organizations with gross receipts that are over $1 million. And you could be at the cuspus, right between under $1 million and over $1 million, meaning like $1,100,000. And that's it. It triggers you. It's a cliff effect, and it could be very severe. So I gave some examples under $1 million. But generally, here's the penalty. For under $1 million, it's $20 per day that you file late, maximum penalty is $10,000 or 5% of the organization's gross receipts, whichever is less. If the gross receipts are over $1 million and filed after the due date, and that includes extensions, so if you file an extension, it pushes back the due date, the IRS imposes a penalty of $100 a day, 5 times, maximum penalty $50,000. As I said before, if you're $1,100,000 and you file late, that puts you into that bracket. Not if you're 10 million and $1 million. So here's an example, just under $1 million. You have a calendar year end, 12/31/15. So you must file 4.5 months after the due date, after the year end, I should say. The due date is 4.5 months. That would put it to May 15th. If you file 2 extensions, which is the rule right now, gives you 3 months and 3 months, that gives you a total of 6 months, or 10.5 months total. Now, let's say you file both extensions, the return would be due 11/15. May 15th plus 6 months is 11/15. If you file on February 15th, 3 months late, you're assessed $1,800. And they could add interest on top of that, and they usually do. Let's say you filed the first extension, which would be August 15th, and you didn't file the second extension. And I'll even add a piece to this about filing. Let's say you filed, but it's late. If you file the extension late, it doesn't count. So just keep that in mind. So let's say you filed the first extension, didn't file the second extension, or didn't file it on time, and then also filed again 2/15. Now you're 6 months late, 180 days, $3,600 penalty. If you filed no extensions, and you filed on February 15th, now you're 9 months late, you're $5,400, based on the penalty of $20. And you could do the math on $100. That would be 5 times. It's pretty steep, especially for a small organization that has a pretty tight budget. Take an organization with $500,000, they don't file, they forget, or they're switching accountants who prepare it, or the other accountant said, I'll get it to you, or they didn't get the information to the accountant. They end up preparing it a year late, not February, all the way. They get a notice of owing $10,000, $20,000. Have an organization over $1 million, they got hit with $19,900 and something dollars, and they were about a year late. Now, in addition to paying, which was raised earlier about, do I have to file the first year? Even if you have no activity, and some organizations start up and they're waiting to get donations or a grant, and it could take a couple of years. What happens? The IRS put this rule in. This is relatively new, this rule, by the way. Came out in 2009 with the revision of the tax returns for 2008. And it said, if you do not file for 3 consecutive years, you are automatically revoked, your exemption, your tax exemption, automatically. If you're not exempt, your income is taxable. And all of a sudden, the next year, whatever your net income is, you pay taxes at the corporate rate. And I believe the highest corporate rate. Well, other related, if you're not exempt from taxes from federal, then you lose your exemption from the state. That includes sales tax exemption in New York State and other states. Might even be real estate tax exemption if you have property in New York City. All the related exemptions get knocked out. They all come from the IRS federal exemption. Also, if you didn't file and you lose your exemption, people might not give you donations anymore because they can't deduct it. And now the IRS has a website that actually says whether you are exempt. You could type in any taxpayer ID number of an organization or their name and see if they are, if they're allowed to receive tax deductible contributions. If you lose your exemption, it gets posted, you can't. You also could lose government grants. You're not exempt anymore. The government's not going to give you money. Now, what do? You lose your exemption. You can apply for restatement. There is a form, 1023, that's the form you originally applied for your original exemption. Or now there's a new easy form, which is fantastic. It came out about 2 years ago, 2014, I believe. And it expedited, made it very easy for small organizations to get back their exemption, get their exemption restated. If you can't restate and get your exemption back for a number of reasons, you've already lost your exemption a couple of times, and you tried to get it back and the IRS doesn't give it back to you, you might have to do one of two things. You might have to start another organization from scratch, change the name, start the whole process up. And you know, a couple organizations that got so messed up with everything, they decided to just scratch it, stop fighting with the IRS, and just kill the corporation and start anew. It's a big problem, because starting it the first time is pretty hard and takes a lot of work. Got to do it all over again, start a new bank account. Your name is similar, they get some mixed up. It's a big problem. Or you just go out of business. You know what? I'm done. I'm not going to do this anymore. Yes?
Well, why can't you just continue without having a 501c3?
Well, you can, but again, two things. You're going to pay taxes, and if you're a public charity, you're probably not going to get donations, because a lot of individuals will not give money. Foundations won't give money. Again, depends what kind of organization. If the board's giving most of the money, it's not a problem. You want to pay. But again, saying you're a public charity is considered very high in our society, and people want to give money. So you don't want to lose. People fight very hard for that exemption and for that designation.
Can we get slide of this? Paper slide or electronic?
I don't know what they gave as a handout. I don't know if they printed it out, but we could talk later, and I might be able to get it for you. Okay, so who must file? Every organization, I said earlier, must file either a 990, a 990EZ, or a 990N, called an e-postcard. And as you asked, and this comes up typically, let's say it's a new not-for-profit, they incorporated, they're going to apply for their exemption, they didn't apply for their exemption. And do they file the 990? Absolutely. As a matter of fact, the 1023, for filing for exemption, the rule says you have 27 months to file for your exemption. And the reason is some organizations need a little time to develop material in order to support why they're exempt. Sometimes it's good not to do it in the first year. But the IRS and regulatory bodies want to get you on the radar, so they want you to file. And if you do file, which you're supposed to, all you do where it says exemption, you put in pending. Some exemptions from filing the 990, certain organizations. Religious organizations are exempt from filing. Some choose to file to get it out there and let the public know what their activities are. And many don't. They're not required to. Government organizations, being branch of government, they don't have to file a 990. Certain political organizations and political committees don't have to. And private foundations do not have to file a 990, 990EZ, 990N. That's because they have to file a 990PF, private foundation form. When is it due? As I mentioned before, it's due on the fifth month, the 15th day of the fifth month, or 4.5 months. So that would be May 15th if you're on a calendar year. If you're a lot of organizations are June 30th, that would put you into November 15th as the due date, 4.5 months. If it falls on a holiday, just like all other returns, it goes to the next business day. You get an automatic extension, meaning that you don't have to give any reason. You just fill out this extension form, you get an automatic 3-month extension. There's a form 8868, that's part 1. And if you want an additional extension, The second part of that form, 8868 Part 2, you have to show cause. The reality is, as far as showing cause, is pretty loose. All you have to say is that you're trying to get additional information or additional information is needed. That's all you have. There's no proving you need additional. So in essence, you really get 2 automatic extensions. If you think about it, since your explanation, it doesn't have to be substantiated, which finally got the IRS through a change in the law to finally modify this and join all other returns, or most other returns, in the fact you don't need 2 extensions anymore. Finally, they came around and said you need 1 extension only. But that is effective for 2016 year, which means that'll be effective for returns filed in 2017. And then you will file 1 automatic extension.
Are you going to talk specifically about the 990N versus EZ versus 990 and like how, because I've been filing 990N and I don't know if there's a limit to the number of years I can do that.
I will be not showing comparison between the 2, but I will answer your question. The 990 EZ is the threshold is the dollars. The 990N is a threshold of 50,000. So if you're under that, you could file it indefinitely. However, the catch to that is New York State. New York State does not accept the 990N. So when you're filing New York State, they have 2 designations for filing, assuming you have to file with New York State. They have a 990 that you attach to the Charity 500, the Char 500, or 990 EZ. And they have a $25,000 rule. So the problem is the IRS says you need to have 50,000 or under to do an N. New York State says you must file a 990 or 990 EZ, 990 EZ if you're over 25,000. So basically, if you have revenue over 25,000, even though for federal purposes you do the N, New York State you have to do the 990 EZ. That's the trip up.
Because we incorporated in Connecticut.
Doesn't make a difference if you're operating in New York. Where you incorporate it, that's another misconception about filing. If you're operating in New York or raising money in New York, you still have to register in New York. All right, but I'll talk to you after class, and I'll be happy to give you a little information on that. Now, if you have a problem doing the return, or I should say, if there was a problem with the return, both things apply. If you did the return incorrectly, and you realize later on that you did it, you file an amended return. And I said also, if you can't get the return done because your bookkeeper has not been around, you're switching accountants, you're at that past the extension point, you can't get it done, then this you will not see in any instructions, but I'll give you a tip. You make the best effort to prepare the return with the information you have, and then you file an amended return when you have the correct numbers. Do not prepare because you don't have the numbers. You do the best you can. You estimate what the amount is. You file your 990 or the 990 EZ, and then you amend it. So either you messed up or you don't have the time. You make sure you get the 990 or 990N in on time. Now, the 990 amended return is not like other amended returns where you just have a separate return and you put the new numbers in and that's it. When you do a 990 amended, you actually use the same form and you put all the new numbers on, and here's the problem. You have to put the old numbers on a Schedule O. So in other words, it's a little bit of a pain to take the old numbers and all put it on this Schedule O, which is just like a notepad, and put what the old numbers are, and put all the new numbers on the same form and file it, as opposed to a separate amended form. And you put the same form in, you check off amended and say what got changed. So it's a little bit of a pain. And on there you must say what parts, what page, what sections were changed, and as far as the old numbers. Okay. Just a little graphical here. There are 12 pages to the 990. It's not a simple little return. So if you could do the 990 EZ or the N, you're going to want to do that. 12 pages and 16 schedules that you might have to do with the 990.
What's the financial limit between the EZ and the 990?
That is 200,000. We're gonna cover that towards the end. As far as the schedules go, which schedules you have to do depends on what information you're putting down and what pertains. If you have certain activity or thresholds, such as paying a management or a highly compensated person over 150,000, you'll have to do a scheduled J. So I believe it's J. So depending if certain things apply, you have to do a schedule. Not every schedule has to be prepared and submitted if it doesn't apply. But it's a potential. I would say on a good number of the returns we do in our firm, we have to add 2, 3, 4 schedules, 5 schedules. Very rarely do we have to do 10 or more. And I put a list of all those schedules over there. Okay, as far as covering the 990, some of the questions you even alluding to, this is a pretty comprehensive form. In the course that I teach at Baruch, I cover it over 4 hours, and we don't even make a serious dent in it because we could pretty much spend a lot of time on not the first page, but a lot of the pages understanding it. So obviously, the depth I'm going to give you is not that deep. However, I'm going to hone in on a couple areas that are problem areas that, from my experience, has been more than not been a problem for a lot of organizations, especially when we review other returns or prepared by other CPAs or preparers. These are the errors that pop up, and the errors that we find that in research that the IRS is saying is a problem. They put out statistics of what a problem area is also. So I'm going to hone in on a couple of those or confusing areas. So at least you take away from today some fundamental issues. Again, to prepare the return, you're not going to get that today. It pretty much takes a lot of instruction. Okay, page 1. Page 1 is pretty much a summary and just has some highlight. You can look at page 1 and go down it and get a feel for what the organization does and how big it is just from page 1. It's a summary sheet. And it identifies the organization and its major mission. But here's some problems. I put a couple of numbers up there. It gets kicked back before they even start getting into detail because the people preparing it don't put the legal name in the organization name. They many times will use the organization name with an abbreviation. For example, I'm not saying they do this, but for example, let's say the American Medical Association is known as the AMA. Okay? They might put the name, because it's so widely known, they might put American Medical Association, parenthetically, AMA. If it doesn't match the IRS database, it's going to get kicked out, just for not using the exact legal name that they have on file. Number 2, employer identification number. Big reason these get kicked out. Either there's a typo or people pick up the wrong taxpayer ID number. Many times an organization starts, they have a sister organization, they look at the wrong documents, put the taxpayer ID number, or they didn't apply for a taxpayer ID number, and they go and use some other corporations. I'll put it down, I'll change it. Gets kicked out. That's easy for the IRS to match. Not as frequent, but people use the wrong year. They're doing a 2015 year, and they had a 14 blank hanging, or they don't realize it, or they're a fiscal year organization, and they use the wrong tax year form, and they don't put it, and they send it in. And I've had this situation happen with some clients who we've taken over, and we have to go back and amend it and get it cleaned up. And it gets a little messy, because then the IRS has 2 forms for the same year, and it's not exactly sure which form pertains to which year. So it causes a problem. Okay, on to page 2. Page 2 actually asks that you put down a description of your major programs. and provide some expense information, and in some cases revenue information related to those programs. One thing that's a problem with doing this, especially small organizations, they don't know what the definition of program means. The word program is a very generic term. It could mean like pretty much everything. I had an event that was a program. I have this project doing. I do this. We're doing this little convention, and they then take that to be a discrete program. What they mean here in the definition of program is a very generic, overriding, discrete activity that the organization does, and if it does more than one, then you break up those and you put two programs. But you don't put every little project and every little activity. Major discrete programs you're supposed to report on. And then if you're a 501c3, which means a public charity, or 501c4, which is a civic organization, if you're one of those organizations, you're required to put in the expenses related to that program, the total expenses. Salaries, related employment costs, if there's rent associated, if you're running a school, and also you do a school and you also have another facility. The school is a discrete program. What are the expenses related to running the whole program? The school has to be put up there. If you get revenue from that program, the school is a great example because you get tuition for the school, and that's identified with the school program. You have to put the revenue associated with the program. That's required. What they ask you for the three largest programs, obviously if you're a small not-for-profit, this doesn't apply, but if let's say you have 4 or 5 major discrete programs, you put the first 3 on, and then there's a line that you put all other programs on 4D, and then there's a total that has to tie to a schedule, or I should say another part of the 990, the functional expense schedule, later on in the return. It must tie to that. There's a problem where it doesn't tie. Many times information is put on here, and then when you go to the functional expense schedule, statement, and you put down the expenses for the program, it doesn't tie to this. And that's a problem. Well, if you thought you could do a 990 yourself, or you went to your accountant who does your tax return, you have a not-for-profit, and they asked them, or that person, if they could do a 990, and they say, look, I've seen them, I haven't done them, I'm sure I can figure out how to do it, I'm a pretty smart person. When they started doing the return, page 1, page 2, they pretty much have a good handle on what they're doing. When they get to this page, 3, this is what they, I guess you would say, what separates the men from the boys, for lack of a better metaphor. This will knock out anybody who hasn't prepared this return, this type of return. They might plow ahead, but this is where you're going to get in trouble. You're going to have some problems and get in trouble. These 2 pages were set up in order to tell the person preparing what else they have to do, what other schedules, what other information they have to provide on the return. So this is to make sure that you didn't forget. When we go through, there are 38 questions. We're not going through it, but I'll highlight a couple of things. And this is where, in the past, people preparing didn't give the information, and the IRS sometimes would send a notice, or during an audit, they would say, I need this information. It was missing. So by putting down this information and saying what's required, you're getting a heads up what you need to do. This will tell you which one of those 16 schedules from A to R you have to do. And it will also say it will tell you if your fundraising expenses are over a certain amount, 15,000. If your what you paid individuals are over 150, then you must prepare a schedule and provide more information. So it will tell you here, does this apply? Say yes. Or it doesn't apply. Say no. And you must check it off. If you say yes, you then have to do the other part of the form or schedule. If you say no, you don't. This is why I say it separates people and really should give person a pause not to do the return if they don't know what they're doing. It is pretty much impossible to do this return unless you have a lot of experience, unless you use the instructions, which includes a glossary and appendices. You actually have to have that next to you when you're preparing it, because if you're not familiar with the return, you need to look up and see what the instructions are telling you certain things mean. And even if you're a smart person, and even if you've been preparing returns, you might not know terminology that applies to the not-for-profit, and you might not even know what this is asking for on certain schedules that don't even agree with what it's asking for in other schedules. You got that? In other words, it defines certain things for one part that doesn't apply to another part. There's no way anybody would know this. And I give you an example here. When it says that certain things apply. When it says, are you a 509A1 or a 170B1A6 organization? If anybody knows what that is intuitively, you are very, very smart and a walking encyclopedia. These are code sections from the IRS. So you obviously, in order to know if it applies, have to look in the instructions and see, am I this type of entity, and where to look to find out if I'm this type of entity. The problem is that you have to say yes, no, and this is very unusual on a form. Every once in a while, it says leave blank. So say yes or no or leave blank. Now logically, if you ever did, we all fill out these forms. You go to the doctor. Every time you walk in, they give you a sheet that says, do you this or no? Does it apply? Did you have this? History, yes, no. Here, there are some lines that are, if it doesn't apply, it says leave blank. If you didn't look at the instructions, you wouldn't know that. And it doesn't say a general leave blank if it doesn't apply. It only on certain lines. So you'd have to look at the instruction for that line. This is easy to get tripped up. Supposedly, if you do this, you're going to cut down errors on not filing things correctly. Common errors, you check yes, but you don't do the form that you have to do the schedule. You check no, and you do the schedule. Very common. On page 5, which is, by the way, so these are the schedules. Now I'm going to hone in on a couple of things on this schedule, specifically that are problems. It asks you that basically, did you file W-2s, W-3s, that means you had employees. Did you file them correctly? And if you had outside contractors, independent contractors, did you file 1099s and 1096s, which you are required to file? It's asking you, did you file it? Then they ask you, and how you intuitively know what this means, for the calendar year ending with or within the year you're doing. That's not a common statement. When they mean file with or within, if you are in a fiscal year and you're ending other than a calendar year, say June 30th, common year end, you obviously don't have a W-2 for the year ending June 30th, so they want you within would be the last W-2 from the year before. So if you're doing 2015, then and your fiscal year and your June 30th, you would need to get the 2014 W-2 or 1099. Common errors here is that, again, that you don't realize that I don't have a W-2 for this year ending June 30th. I don't put it down. That's not true. You have to go and use the prior year. Okay, here's one that really trips up a lot of organizations, even ones that are not small. They could be a couple of $1 million. They don't know this rule. I've had organizations that our firm has taken over and done work for, and they've been around for years, and they didn't know they had to do this. And so when they actually read this on this form, it brings it to light. It says that if somebody gives you money for a contribution and they're getting something back for that contribution in relation to it, and the amount is over a certain amount, $75, you as an organization are required to give them a statement saying that, like any other statement or a contribution, saying, you could say, thank you for your contribution of $100. Please be advised that a portion of that, whatever that amount is not a contribution and relates to tickets or whatever. And a very common is an event where somebody buys a ticket to an event. They're getting something back. They're getting food. They're getting drinks related to that. So, and this is called a quid pro quo kind of connection exchange transaction. So an example, you buy a $100 ticket to an event. $40 is really estimated how much the food and drinks are that you're getting back. Therefore, only $60 is tax deductible. And since it's over $75, the total amount they're paying, you must give them a statement, some kind of notice. You can even do it on the web if across the board it applies to everybody, but you must give people a notification of how much is the contribution. This is IRS rules, and you must also check off, and here's where you get tripped. Check yes if you notified the donor of this, yes.
If you just have a fundraising event, maybe one organization I'm involved with is about to have a play is going to be produced, and so anybody can come. I don't think you have to buy tickets, but the hope is that people will donate, and they'll have refreshments out in the lobby. That's not.
I would take a guess and say that's de minimis, that's too small, if it's really tiny like that. But I'm really talking about you go in, there's a buffet, most events are done like that, and you are getting something back, and the organization must tell you what that's worth. A simple way is take the total cost to them of doing the event divided by the attendees, and you come up with the value of what they're getting. And that's what it's costing, that's what it's worth for. It could be a little hairier, there could be some free service. It's the fair value of what they're getting back.
But if they're not charging tickets to go see the production, you're not saying that, deducting the price of a ticket.
It's not necessarily charging, it's what are they getting back for it. So if they're making a contribution and they're getting something back, you're supposed to be told that. You could try to do form over substance, but it's really the intent. You had a question? No. Okay. So this is required, and as I said, most donors don't even know you have to do this, so it's a problem. Governance. Getting over to page 6. This talks about your governance, how the organization is governed, what information the organization is providing to the board, what information the organization is providing to the general public. Are you complying with certain types of activities? Meaning, are you doing what you're supposed to and letting the public know about that you're a public charity, how your 990 is presented, where it's available, and how you give your 990 to the board. There's a number of questions on here that they want you to answer yes or no. The problem with this form is that it's not so easy to know the answers to it because it's not in your financial records. This is textual. The information, does your organization do this? Does your organization, how does your board approve your 990? This is information that has to be gleaned from other sources. And one, many times people don't even know what that means. And two, if they even know what it means, they don't know how to get the information. So it could be a big problem. Okay, I put a little time up there because I'm always running a little late with questions, so a little late. Just so you know, this class ends at 11, but I will stick around if I don't finish, and I'll be happy to answer your questions. Page 6, a couple of things on that page that I just talked about. That's governance. Here's where problems come up, and it's knowing what it means. It says the number of voting members of the board of directors. How many voting members are there? This is an issue where people, first of all, don't understand One, if they should be voting or not voting. For example, an executive director, many executive directors have voting rights on the board. The problem with that, the board's supposed to oversee management. So it's kind of a conflict. So many organizations know that the executive director does not have a voting, will be on the board, but is a non-voting member. That's very typical. So that number of total board members and total voting board members will be different, usually by the executive director. Then there's another box that says number of independent voting members. For example, I have a board member who is also the chief financial officer. Chief financial officer gets paid. Since they get paid, by definition, they are not independent. And you must minus and take them out of the equation. They are not a voting member. So when they say, they're not an independent voting member. Again, if you get paid, it impinges your independence. That's one of the criteria. There's others. If I'm not an employee, if I'm an outside independent contractor and I'm on the board, let's say I'm an insurance broker, and I get paid more than $10,000 as an independent contractor, it impinges my independence. So I'm not an independent voting. If I have members or family members where there's transactions between them and the organization, not between me and the organization, but between the family members and the organization, that impinges my independence. I'm no longer a voting member. If I have, in other words, if I have a child or a spouse who works for the organization, they get paid, it impinges my independence as a voting. The organization just has to make a reasonable effort to find this information. Again, many times the ED is paid. They're not going to put it that they're voting, okay? But others will put down their voting. Many times they won't. And they're getting paid and also put down they're independent, and they're not. Common problem. Basically, here's another one. What's a family relationship? You have to look at the instructions here to see how the IRS defines, in this case only, for the 990 purposes, what is a family relationship. In other words, an uncle. Uncle is not on there. So an uncle, if I have an uncle or a nephew working, it's not an ancestor or a great-grandchild. It's not considered a family relationship. You must identify each family relationship on Schedule O. It might be as simple as I have an organization, husband, wife, give a lot of money. They're on a board, very, very big not-for-profit. Bob and Nancy, trustee, are related. Or my wife and I are on a board, Larry and Mindy Scott are related. That's all you have to do. You don't have to go through long detail, unless, of course, there's some financial information. But if we're on the board, that's sufficient as a disclosure. Again, not easy to glean this information. This area trips up a lot of people. There's a question on line 11 that says, listen carefully, it says, was Form 990 in the schedules given to each voting member before it was filed? The first year this came out, not-for-profit boards were going a little crazy about this, didn't know how to handle it as far as, oh no, now we have to do this in order to show that we're doing our job and overseeing the organization. Not necessarily applicable. It's not necessary to say this is the case, but you're just supposed to say if it is the case. And think of what it's asking. It's not asking, did the board, every board member get and read the 990 and approve the 990 before, which, by the way, members should do, at least the committee. It's saying, did they receive a copy of it before? And that indication of what it's doing just meant, did they get it? So if they get a copy of it a day before it's filed, what does that really mean? So you could try to get it done, and sometimes time is of the essence. You got to get it out. You can't necessarily give it out to the whole board and get it to them, although many organizations do comply with this. But if you don't comply with it, and you have another procedure, it doesn't mean that you're not doing your job. You could say no, and it doesn't mean you're poorly running the organization. You could say no and just say, or you could say yes. I have a no example, but I'll tell you in a second. For yes, board of directors, yes, this is our procedure. Board of directors delegate authority to review and approve the 990 to the finance committee. Once approved, copies given to each board member, then filed with the IRS. That's simple enough. That's saying yes. Let's say you said no. You could say no. A copy of the return is provided to our executive committee, which they approve it, and then it's submitted, and then it's available to any board member upon request. A lot of my organizations do that. That's fine too, but you must report what your process is. And you should be somewhat honest there. There's another one that says, do I have a conflict of interest policy? The IRS wanted to know that, wasn't required. However, under New York state law, it is now required. So this is a moot point for whether you have it or don't have it. Every organization in New York state should have, not-for-profits, should have a conflict of interest, especially if they're being audited. Their auditor is going to bring this up as a violation. It's good. It's just good practice. If I had to find one page on the form which seems to cause the most problems, one page, I would pick this page 7 and the next one 8. And not always for the reason you would think, but for the reason you do think it is a problem, because it's disclosing salary, which people do not like other people to know. And this is where another corporation, small corporation, there's no way a small, wholly owned corporation, retail store, professional service corporation would be disclosing the salary of the people who are running it, the owners, the partners. But not-for-profits do not have a choice with certain employees and certain people that are involved with the organization. So this causes a lot of problems. And it's also a very difficult part of the form to prepare because of a couple of things. First of all, it says you must put down compensation to current or former directors, officers, trustees, or key employees. I used the little term .key to remember directors, officers, trustees, and key employees. Also, the five highest compensated employees. I use the term highest. The five current independent contractors, if they meet the test, must be reported on here. You must report compensation from the organization, and here's one very difficult, from related organizations. This information is not always easy to get from a sister or a supporting organization that's related. And then if you're over a certain threshold, you must complete another part and also Schedule J, in addition to filling out all the details on here. Some definitions. Again, you better have that instruction next to you, because here's one that I said earlier that defines executive directors different than it does on any other part of the form. You must talk about and disclose information about any director, officer, trustee, and any person who is the highest management official. Who is usually the highest management official? The executive director. If you look at the instructions, it says for this part to treat the executive director as an officer, when legally they're not in New York State. But on the first page where it says that an officer should sign the form, and the executive director signs it, for that purpose, the executive director is not a legal officer and should not sign the form. So you could see a conflict. God bless you. But if you did not look at the instructions, you would not know that the executive director, who's not an officer, should be listed on this form. So that's a definition. For directors, officers, and trustees, even if they receive zero compensation, I said you must report compensation, but guess what? Even if there's no compensation, you must list every director, officer, and trustee and put 0. If they served at any time during the year, whether it's a calendar year you're on or a fiscal year. Highest compensated employees is anybody who gets paid over $100,000. That's considered highest compensated employees. And again, you're supposed to do the 5 highest. Key employees is anybody who gets over $150,000 and holds a responsible position in the organization. Then, if they meet that test, they go on to another schedule and have to give more information. Now, here's a confusing thing. Directors, officers, and trustees, if they served at any time during your operating year, so if you're on a fiscal year ending June 30th, you get reported over here, right? However, if you're the highest compensated employee or you're a key employee, you only get here if you meet the test for the calendar year. You got that? Very confusing. So you get listed. So here, I'll give you a concrete example. Might be on the next slide, but I'll say it now. Let's say I'm a highly compensated employee. It's a fiscal year, June 30th. I started January 1st of the end of the year. I got paid. You don't meet the test, you don't get put, even though you would meet the test for the year of making over the 100,000 or a key employee over the 150, you don't get put on because you only do it if they're on the calendar year when directors, officers, and trustees are on your operating year. Tricky, and usually trips up most people that haven't done a lot of these returns. Another thing so some errors. You have to include every officer, even if they don't get paid. A lot of times they're left out because they didn't have any money, so you don't think you have to report them. Failure to check off the executive director as officer. That's common. During the year, during the calendar year, I said key employees are highly compensated employees. Some problems about the dollars, knowing whether to pick it up from the calendar year information or the fiscal year, meaning your books. Here's probably one of the areas that are commonly done wrong because of lack of information. You're also supposed to talk about benefits that these people receive, employee benefits. And that information is not clearly in the general ledger. So meaning, very simple, the executive director gets a health insurance policy. You pay for it. The organization pays for it. And that's included with all the expenses in the health benefit or employee benefit general ledger account. You're supposed to put in a caption that they have that non-taxable benefit. They got pension, non-taxable benefit. That is typically not done. If I had to get one area on this form that's done wrong more times than not, it's not putting that down. Because when you say compensation, when it says non-taxable compensation, people don't really understand what that means, which includes benefits, and they leave that out. Another problem, when we go on to the statement of revenue, page 9, they ask you if you get any non-cash contributions, donations of any. Stock is a common example of non-cash. I have an organization that does training, and they get expensive shirts from a shirt manufacturer, high-end shirts. I mean, worth to the tune of $40,000, $50,000 of shirts to give out. Hundreds of shirts to give out to the attendees so they can go on job interviews. I think it's a very benevolent gesture. But anyway, if it's over $25,000 you received, you must then go and complete a Schedule M. Again, it's triggering more reporting. Many times non-cash contributions are not reported because they don't appear anywhere. I remember going down to a client, talking to them before an audit began, and I saw on the windowsill a whole bunch of merchandise, and I was just curious. I said, "What is that?" "Oh, we got donated all of that for our program." Didn't appear anywhere. I said, "That's supposed to be booked as non-cash contributions." They go, "Really? I didn't know that. I thought only cash." So it's just lack of knowledge, and a lot of people preparing. Another thing that I could spend a whole hour talking about, and I won't even get into detail because I usually get a lot of questions, is if you have unrelated business income. you're supposed to report it. Unrelated business income is income that's not earned for what your mission is, and you're supposed to then file a separate return and actually pay income tax on it. And you'd be surprised how many not-for-profits are subject to that and don't even realize it.
Can you give a simple example?
I hate to, because, as I just said, once I say this, I get a lot of I will give you one, but I will not pursue talking advertising income in a journal. Maybe not a dinner dance, but a membership journal. Advertising income is not considered exempt purpose. I'm going to leave it at that. That usually gets a whole conversation, because I could say there's a large percentage of not-for-profits that do this and have this and don't report it. Obviously, if you know about it, even if you don't know about it's one thing. If you know about it and you don't want to comply and pay taxes, you're not going to report it. So it's kind of like the IRS says that you must report illegal transactions on your tax return. I always found that to be extremely funny. Yeah, I sell drugs and I make money, and I'm supposed to report that I made $100,000 this year from it and pay taxes. It's the tax law.
Is there a cutoff for unrelated business income?
Yeah, there's $1,000 for gross, not for net.
It's pretty low.
It's pretty low, exactly. So we have a little time. I'm going to try to get into a couple remaining things. The schedules. 16 schedules, most don't apply unless you have a lot of other related transactions. You have to do a schedule, or certain transactions, fundraising, you have to do a schedule. They don't all apply. If they don't apply, you don't do it. Two that typically apply to public charity: Schedule A to most public charities, and Schedule B that gets contributions. They're the only ones I'm going to talk about. Schedule A by itself, we can have a half an hour conversation. So just be aware of that. When I show you the slide, you're going to find it a little overwhelming, but it's for illustration purposes only. Schedule A, extremely important. Maybe not all the schedules are important in the sense that you should report it, but if you don't, it's not the end of the world. Schedule A is very important. The reason is Schedule A is what determines whether you stay an exempt organization or not. Whether you stay a public charity, or whether you don't meet the test each year and you actually get downgraded to a private foundation, or you don't meet the test each year and you get downgraded altogether to not an exempt organization. And this is something that is not prepared correctly. This is what, when you're a public charity, this is something commonly not known. When I ask this question in seminars, how do you define a public charity? I usually get a lot of different answers. The organization does great work in the community. They do a mission. They provide services, the government, all true. But what makes a public charity is basically getting public money, support from the public. The more support you get from the public, the more public charity you are, as far as defining you. The less public support, the less you are a publicly supported charity. And what determines that is the schedule and preparing the schedule properly. So it's very, very important the schedule is prepared. It's very important it's prepared properly. And it's also one of the few schedules that are very number-oriented. And then when people are preparing it that don't understand it, they get tripped up because they're not very good with numbers. Most of the other parts are not so detailed. You do need to know accounting. This gets to be a little bit more numeric, and you have to understand what it means, or you could get downgraded. They test for two things, basically, two parts. Depending on what level of a public charity you are, what designation in the IRS. Most people, or a lot of people in the not-for-profit community know about the term 501c3. That's thrown out all over the place, thrown out on the radio, Cars for Kids. Everybody kind of has understanding that's a public charity. But there are actually a bunch of levels within the 501c3 as far as your public support. And depending where you fit, you have different tests. And there's 2 pages on Schedule A. There's one page and the other page that will tell you have to actually complete depending where you get most of your support. Basically, part 2 says I get more than a third of my support from contributions. Okay? If you meet that test, you fill out that part. If I get most of my support from contributions and program service revenue, membership income, and less than a third of my income from investment, then I do the second part. If you get more than a third of your income from investment, you're starting to what they call tip over to being a private foundation. A lot of organizations don't know, especially small ones that are 75,000, 100,000 budget. Even if you do a 990 EZ, you have to do this form. You don't realize that you have to do it and it's not done. And the IRS will contact you if this form is not done. It many times is not done, or the organization puts their numbers on the wrong part, not knowing which one applies, not understanding the designation. So if you remember that first part, over 33 1/3 from contributions, that would mean you fall under section 170B1A6, and it's one of the highest levels of getting support. And then you fill out that section, which also includes, by the way, government grants. Then if you don't, you must fill out the other part. Again, so just staying with this one that you're basically supported from contributions. I'm going to show you the next page. If you have sunglasses, you might want to put it on. It's a lot of color in here. But I'll mention one thing. If you get large contributions from a few people, you actually have to track that separately. There's no way on here that it's reported, except in one section when you go over a threshold. So in addition to getting contributions, putting it in your general ledger and recording it, certain contributors that give, and using 5,000 is a good cutoff, giving 5,000 or more should be tracked, unless you're a very large organization, on an Excel spreadsheet from year to year, because you're going to have to report some of that information. And it also affects your public supporting ratio. Okay, here's that color-coordinated form. And I'm going to kind of give a synopsis of this rather than go into all the calculations, but just give you two things to point in. As I just said, if an individual gives over a certain amount, 5,000 or a 2% test, and that's 2% of 5-year average, got that? So the organization gets contributions 1, 2, 3, 4, 5 years, saying they're in business for 5 years, of course, assuming that. And then somebody gives over 2% of that total number, you must track that, and it gets popped out of the calculation to see if you're publicly supported. Basically, it's saying that if a few individuals give a lot of money, and they're using a 2% test, and if these people are giving a lot of money, then they're no longer as publicly supported, it's more privately supported, and that changes the ratio. Yes?
Okay, are there 2% of this larger contribution that counts as public support?
Say that again?
So you said that some donors will give like 5,000, so it doesn't really count as a public small individual contribution within the 33% ratio. So my question is, if still 2% of this larger contribution, only 2%, will count as a public support?
Okay, it's actually, I wish I could give you even a simple answer to what you just asked. It's not really that the 5,000 gets bumped out. It basically says it's in relation to other support. So it's a relative test. So basically, 5,000 for organizations that get a lot of support or get hundreds of dollars from a wide amount. A couple people give 5,000 who won't make it when they do their percentage over 5 years. It's only saying if their percentage, and I use 5 because they use a test of 5,000 as testing, you take their numbers and compare it to everybody else. If it turns out you get most of your money or a lot of your money from these few individuals, then the amount that's over the threshold will be knocked out for the calculation. So it doesn't mean you're automatically knocked out just because you give 5,000. It's in relation to everybody else. If I get contributions $100,000 and most of them are for 50 individuals, and I have 3 individuals get 5,000, when they do the ratio of what you gave versus the total, it won't make a dent, or make a very, very small dent. So again, it's relation to the total. And they're trying to find out a better example, and I don't want to get too caught up, but I talk to you later. A good example is you have $100,000 this year, and one individual gives 50. A rich donor on the board or somebody that believes in the cause gives 50. And they do that every year. 100,000, 5 years, 500,000, and that person gives 50. 250, half. The amount that through the test that's over the 2% is going to get bumped out. A big part of their money is going to get bumped out of the calculation. And when you do the test, it might be that you're not publicly supported anymore. That's a better example. So if 5,000, a small amount, might not mean anything. It's in relation to everything. And again, it's a little complicated on the formula pulling out. They also let you bump out unusual grants and contributions, meaning one year somebody gave me $1 million. Very lucky. My organization's only $250,000, and I got $1 million one year, 4 times my normal. It's unusual, and it's so unusual that the IRS will let you pull it out of the calculation, because if you don't, it's going to screw up the percentage. It's not what I usually get. It's very unusual. So on the top, they actually say pull out unusual. They don't even have a line. If you look in the instructions, it says pull it out. That's why this form is very, very, it can be very complicated. And if you go through the numbers, in this case, they're over 33 1/3. It's fine. But this trips up a lot of people. This is really, somebody needs to have the instructions and know how to complete this. And it's very important, as you could see. The other form that's very important, only because the IRS puts so much emphasis, not important for the I guess in both cases the IRS puts an emphasis. They put an emphasis on this form too, because they want to make sure of where you're getting your money from. And it relates, by the way, to the other schedule I'll mention in a second. Schedule B is contributions. And organizations do not like to put this down. And individuals don't always want to have the name. You're supposed to put down, if you meet the tests of contributions. In this case, 5,000 is a threshold. You must put down contributions you read. It's 5%, or if you are a certain type of not-for-profit, it'll be 2% or 1%. So it's the lower of the two. If you exceed that threshold, you must report. This is not open to the public. So the IRS does not report it. New York State doesn't report this information. Unfortunately, some other states are not as careful. So if you send them a 990, they might not pull out Schedule B. But contributions an individual gave is not public information. This is not prepared correctly. I'm going to jump through this with one thing. Sometimes a donor says that I don't want to report my name. It's anonymous. I don't want to, but according to the IRS, you can't put anonymous down, because the IRS wants to know if you're one of those people that just gave 100,000 and then you put anonymous down, and it keeps you out of the ratio by not saying who you are. You really are, you gave 100 and you gave another 100. They want to know, or that you have some relationship with the organization. They want to know that. Okay, but some of you do the 990 EZ, and I do want to cover that. The young lady over there asked it. The 990 EZ, it means what it says, EZ. The other form, 12 pages. This form, 4 pages. It's a lot less information, and a lot of the detail is not needed. You could do summary information. One line says cash and investments instead of all kinds of breakdowns. A lot less detail, a lot less work if you don't have to do it. And out of those 16 schedules, only 8 are required on here. So obviously, if you don't have to do the 990, you would definitely be better served doing the 990 EZ. Here's your thresholds that you were asking. You have to be under 200,000 of gross revenue, and you have to be under 500,000 in total assets. So what would throw this off, let's say an organization got a building donated 10 years ago. They have, and assuming, or that is not fully depreciated, and it's worth way over $500,000. Going forward, and they don't have much money coming in, they would still have to file a 990 because they are over the $500,000 asset threshold. Problem? Many organizations don't realize they can file a 990-EZ and file a 990. I had a gentleman who came in. He was it's a foreign NGO, religious, kind of a religious organization, and they set up in the U.S. He was basically based in Germany. Went to a big accounting firm, and the accounting firm did a 990. It's a small organization, $100,000 of revenue. Did a full 990, and charged him for a full 990. And when he came to me, I said, you didn't need a 990, and you shouldn't have had to do it, and you shouldn't have had to pay for it. I don't know if the accounting firm knew about the 990-EZ or he just said it's better to do a 990. Here's my suggestion when it comes to reporting. And I preface this by saying don't do anything illegal or purposely misrepresenting. But if you don't have to do something, don't do it. It's that simple. The more stuff you do, just the more stuff you're exposed to. Again, do anything that you're required to, but you don't have to do more. Some organizations want this information out there, and if they choose to, that's fine. That's pretty much all on the 990-EZ. The 990N that was talked about is relatively new. It came out for 2007 year, I think it came out, so it was effective for 2007 year. It came out in 2008. Very simple. You can't say super easy, but it's called a 990N or a e-postcard, electronic. You cannot, you can't even paper file this. It's electronically filed. You could do it with the IRS, or a tax preparer can send it. It says that if you're, and here's a key, not if you're 1 year under or over, but if it's normally 50,000 or less in revenue, you file this. So if 1 year you get 60, but you normally are not, every year it's 50, it says normally. So that's something to keep in mind.
So you go back over the average of the last few years?
Yeah.
You don't know where you're going.
Correct. It's common sense. Well, each year you do the 990N based on past, not in future. So based on the past, in the last couple of years, I've had under 50. 1 year I had 60, but out of 4 years I only had one. It's a common sense test. If every year you're more, except for 1 year, then you're not normally. Normally is, majority of the time, common sense. It's also due 4.5 months after, after the year ends, which would make it a calendar year with May 15th. Here's something different. There's no extensions like the other one. You can't file an extension doing it late. They made it so simple, they said do it. So if you don't file on time, you actually don't even get a penalty. But if you don't file on time for 3 years, you will lose your exemption. And from what I've seen, if the IRS has said, I've seen this once or twice, if you haven't filed, you will actually get a notice. That means it's the second year. If it's the first year, they might not know and have you on the radar. But if you file 1 year, you don't file the next year, you're going to get a notice you didn't file. And a simple reminder, you should file the 990N. But again, you don't file for 3 years. And for a lot of small organizations that don't have sophistication or have a board that's knowledgeable, this is where many organizations lose their exemption. They didn't file 3 years. All they had to do is this simple form. And remember, it wasn't around a long time. So if you had to do it for 2007, 7, 8, 9, in 2010, that's where, the proverbial hit the fan. Because all of a sudden, thousands of exempt organizations lost their exemption. And literally, probably more than thousands, more like tens of thousands, that didn't file for years and years and years. And they got notice, and everybody started scrambling around. What do we do? Because we lost our exemption. Which gets me to the next topic, which is, what do I do if I lose my exemption? So here's an example. I didn't file 13, 14, and 15. Probably it's a bad example because we're now in 16 and you still could file 15, but assuming we're past the due date and you don't file for 3 years, 990, 990-EZ or 990N, your it's not optional where you get a letter like your return, your individual return, I didn't file it. You get a return, you get a notice from the IRS that says you did not file your return, please file it, or we're going to hit you with a penalty for not filing it. No. They don't even go that way. No notice. You just lose your exemption. It's an automatic revocation. And for organizations not very organized, they got slammed with this. I mentioned before something, I'm going to repeat it again because it trips up a lot of organizations. It really has to do with the last slide. If you file a 990N, and the IRS says, I have revenue that's $30,000, so it's under 50, I can file a 990N. If you meet the test and you receive contributions in New York and you're over 25,000, you're going to have to file a CHAR 500 with a 990 EZ or 990, which means I didn't file a 990 EZ because I met the test of the 990N, but New York State says I have to file a 990 EZ. So basically, what does that mean if you're in New York and you qualify? It means you have to do a 990 EZ if you're over 25. So just a point. Okay, so you lost your exemption. The IRS put out detailed information of how you restate how you get your tax exemption restated. One of the things that I sent the school that they printed out is actually something from the IRS that goes into more detail about how you restate your exemption and which steps. There are actually three different areas that you would have to qualify or fall into in order to restate. In order to restate, so I didn't file a 990 for 3 years. Let's leave out the 990 EZ for a second, or the N. I didn't file for 3 years. The procedure for restatement. The IRS put out a revenue procedure, 21411. They said these three methods that I just mentioned, fall into three categories of methods. Method one is the easiest, assuming you qualify. Let's say your organization was supposed to file a 990 EZ or a 990N, and you didn't for 3 years. You now meet one of the criteria for method one. It also said you didn't previously lose your exemption. It's not something you repeatedly, every couple of years you don't do this and you get revoked. So you couldn't have your exemption previously revoked. And you have to apply for restatement within 15 months of one or two things. The later of the date the revocation letter is, or the date in which the IRS posts the organization name on the revocation list. Sometimes they're a little behind in posting. So whichever, the later of the two, basically in your head, as soon as you know about it, you got 15 months. If you're a 990 EZ or N, and you fall into that category, you can use this easy approach. And this approach is very easy. Again, let's say you're a 990, you bumped right out of that. You can't do that. So now I have to do one of two. Method two, I'm not eligible for the streamlined, simplified method of restatement, but I did it within the 15 months. They're a little easier. Then I can use method two. If I'm not a 990 EZ or N, and I'm doing this after 15 months, I got to use method three. Logically, it means that as the methods go down, they make you do more, bottom line. So I'm not going to go into the methods in 2 or 3 because it's involved with actually almost applying again with some limitations. It's almost like the first application. But I'll talk about, since a lot of people come to these seminars that are small organizations, I will talk about the simplified really quickly. I'll go into detail. The 2 forms you have to file to get your exemption back is pretty much what you have to file to get your exemption to begin with. Basically, if I'm when I apply, if I'm a certain size organization, I file 1023. In the course we give at Baruch, I actually cover what the 1023 is. It's pretty involved, and it's a lot of information you have to provide. It's lengthy, and it's usually not done by people experienced. The 1020 Easy is a new form. It just came out basically a year and a half ago, and it means what it says. It's easy to do, and a lot less information is required. So if you're going to apply for the first time, you could do an easy if you qualify. And if you're trying to restate and you meet that first test, that first method, you could use the 1023 Easy. And just some quick, and pretty much there's not much more on my slides. If you got automatically revoked under section 6033J1, you're revoked because you didn't file for 3 years, and you want what's called retroactive restatement. Basically, it's saying, I want to go back as if I filed all 3 years. So I never lost my exemption. It's retroactive. But the failure was a mistake, was beyond my control. I had an organization where the person who was supposed to file it sent in the wrong form. Then they tried to contact, the person wasn't available. Then they tried to find somebody else. The other person didn't do it at all. By the time they came to us, 3 years are gone, they got revoked. So I mean, that was a non-intentional, really, to hide anything. And they now have in place a process to make sure they file every year. If they have that, they qualify, and they can do this streamline. It's the first time they've been revoked. They did a 990 Easy year end, as I just said. It's not more than 15 months from the date that they, it's either been posted or they got the letter. It wasn't intentional, and they promised to. I promise to file now every year. They can do this 1023 Easy form. If they don't qualify under method 1, and they fall under method 2 or 3, they now have to do the full 1023 form, and which requires a lot more information, a lot more detail, and explaining why they didn't file and why they got revoked. And again, it wasn't intentional, and they fill out this form, and they can get restated. I saved you the job. Okay, guys, since this is such a small group, I'm around. I can answer those questions that were raised. And thank you very much for coming. And any questions, just come up or I'll come over to you.